Learning Objective 2 tackles that very interesting question of how do you value accounts receivable when it changes all the time, number one, from we learned that from Learning Objective 1. But there's another really unique issue about accounts receivable. Not everyone who you're waiting to receive money from is going to send you the money, right? So in essence, we are, for a better lack of a better word, we're going to get stiffed by somebody. Someone's not going to pay us, even though we've been waiting to receive the money. We did the work in good faith. Um, Sometimes receivables don't turn into cash because the people don't have a cash. I mean, when you look at this particular period of time that we've lived in over the last year, you've had a lot of businesses that have gone out of business, which means they haven't been able to pay some of their bills, which means that some companies that have been waiting to receive money from them aren't collecting that money. And so that creates a very interesting dilemma for accountants, right? Because accounts receivable is an asset. And as an asset, it's going to be on your balance sheet. And one of the things we have to do, right, the principle of conservancy, is we cannot overstate the value of our assets. We cannot overstate the value of our assets. So, how do we account for the fact that some receivables are not going to be collected? That's what this objective is going to explain. Okay. We're going to be looking at how they value accounts receivable, knowing that some of these accounts are not going to be paid. We're going to be introduced to this idea that if an accounts receivable is not paid, we call it an uncollectible account receivable. And for those receivables that we do not collect, we actually can write off what we cannot collect as something called a bad debt expense. Okay. If you are a small business, sole proprietor, partnership, um, you can simply have a bad debt expense anytime you've identified an account that's not going to be, you're not going to be receiving anything from it. Corporations have a different set of rules under GAAP. They can only recognize bad debt once a year, which means that they have to, in essence, estimate what their uncollectibles are going to be every year in order to take that expense. And that's the tricky part of this part of the chapter as well. So, a lot to tackle. First thing is GAAP requires us to do or to use what we call an allowance method. Okay. Like I said, smaller companies can simply directly write off, that's supposed to be two F's, they can directly write off accounts once they have recognized the receivable that's not going to be received. They can just put it to bad debt expense. That's not something public corporations can do because GAAP says, look, you have to estimate what your losses are and keep track of this more carefully. Why? Because we want to make sure we're matching our expenses better. And so we're going to get into that. First, how accounts receivable looks on the balance sheet of a corporation. Well, accounts receivable will be listed next to another account that's called the allowance for doubtful accounts. Now, the allowance for doubtful accounts is a contra asset account. So it's a real account, but it has an opposite balance to receivables. This allowance account basically is the estimate that the company made using GAAP of how much of their receivables are not going to be collected. So they make an allowance for them. The allowance is shown on the balance sheet sometimes, actually almost all the time. But what's left is the difference. This particular difference is the $500 in this company, the $500 of receivables minus the $25 allowance means that they have valued, this is the actual value, okay, on the books. Remember, it's an asset. It's going to have a value. So the value of the receivables is $475. Now that is the difference between what is the receivables on their books minus what they have allowed, right, for bad debt for that year. So that's the value. This is also called the net realizable value. You're going to learn that term as well here. Typically, this alternative presentation is the norm on most balance sheets that I've seen, where you'll see the receivable account listed net of the allowance. So this means that this is the net realizable value of accounts receivable because they have taken away a certain portion of it as the allowance for bad debt. So this is normally what you will see on a lot of balance sheets in corporate America as we look at them. You'll see this accounts receivable net of an allowance. All right, so I'm going to move through this to look at the difference between how we actually do the entries for this. So again, for smaller companies that are not required to use GAAP, they can simply directly write off any uncollectible account as bad debt. So in this particular case, this company, Warden, identifies their customer, M.E. Doran, that owes them $200. So this $200 is sitting in accounts receivable because they're waiting to receive it from M.E. Doran. And they've now deemed it uncollectible as of December the 12th. So basically, they're simply going to have a bad debt expense for this for $200, and they're going to remove M.E. Doran's account from their accounts receivable. The credit to accounts receivable lowers the account receivable. So this is how a direct write-off method would be used for smaller businesses that are not subject to GAAP. It's a little bit more difficult to do that under for corporations, because for financial reporting, we have to follow the rules of GAAP. So what does that require us? It requires us to put together something called an allowance method for uncollectible accounts, which means that once a year, we estimate, usually before we close the books, we estimate how much of our receivables are going to be uncollectible. We estimate it for the next year. Okay. That estimate is usually based on history. We've most of the time we're a corporation that's public. We've been in business for a while, and so we have a history of how much of our receivables have normally gone uncollected. And so we can use it either as a percentage method, which is one method I'm going to show you, or some companies put together an aging of their receivables, which means the longer they're waiting to receive this uncollectible money, the less likely they need to write it off as uncollectible. So we're going to look at that, but they have to estimate. This estimate comes once a year at the end of the accounting period. So at the end of the accounting period, you're going to see they're going to debit their bad debt expense one time. If they're a corporation following GAAP, they're going to debit bad debt expense one time at the end of the period. And they're going to credit that contra asset account that you just was introduced to a few slides ago, the allowance for doubtful accounts. The allowance for doubtful accounts is to accounts receivable what the accumulated depreciation account is to, say, equipment. It's a contra asset that shows up as sort of a piggyback account right on top of that. So this allowance for doubtful accounts has all the money that the company has expensed in it. And so what the company does as the year goes on is they will recognize bad accounts. Okay. And as they recognize bad accounts, instead of debiting their bad debt expense like the other businesses can do that don't follow GAAP, they're going to debit the allowance account in order to remove their accounts receivable from the books. Okay. So think of the allowance account as sort of a bucket of money that the company has put aside. And as they recognize they're not going to collect any money from a customer, they pull the money from that allowance bucket in order to close the accounts receivable for that customer. Because you don't want to have the accounts receivable there if you already know it's bad, right? But again, using GAAP, we don't use a direct write-off. So we don't just do a bad debt expense for every account we identify. We only do that once. The pool of money in the allowance account is what we use through the year to close the bad accounts that we are not going to collect from. So here is a little bit about how it works. At the end of a year, again, this company uses December 31st as their year end. They have to estimate their uncollectible. So this company is a furniture company, Hampton Furniture. They have credit sales of 1.2 million. Now, this is a very nice term to know. I don't know if you've ever heard of it before, credit sales. But credit sales is the same as selling on account. Okay. So when you see credit sales, it's a sale on account. All right. So Hampton Furniture sold $1.2 million worth of furniture, I'm assuming, on account. That's what that means. In the entire year 2017. However, 200,000 of that 1.2 million is still uncollected, which means that $200,000 is still in accounts receivable. Okay. So that's how to read this, very important. The credit manager has estimated that 12,000 of the 200,000 in receivable will prove to be uncollectible. Right. So it's the end of the year. They are a corporation. They are using the allowance method. This is what they're going to do. They're going to debit their bad debt expense by the amount that they've estimated is not collectible. And then they're going to move that money with a credit into the allowance account, the allowance for doubtful account, right? Which is that contra asset account that piggybacks the receivables. This is what we use to shrink the value of the receivables on the balance sheet. This is the money we use to close any and all accounts that we've identified through the year. But the bad debt expense for GAAP, for folks, corporations that use the allowance method, is only going to be done one time at the end of their fiscal year. Okay. So for Hampton Furniture, their balance sheet shows the $200,000 of receivables that they have on their books and shows the allowance of $12,000 that they've made with the estimate. So the actual value of the receivables on the balance sheet this asset is actually valued at $188,000. Okay, that's the $200,000 of receivables minus the $12,000 they have allowed for bad debt, in essence, for uncollectible account. So this 188,000 is what we call the net realizable value of the receivables account. Okay. Again, another term you will see. So we're back to Hampton Furniture. And now we are in March. Okay. And we have recognized that $500 balance from a customer, RA where, is not going to be collected. So the vice president of finance wants to write off RA ware's account. Maybe they are aware that they're never going to get that money. Okay, little snort. So how then would they write off this write-off? Oh man, I'm just losing it today. Well, again, on March the 1st is when they've identified this person in this account as bad. So they can't write off, they can't use the bad debt expense because they already did that. But they can use that allowance account to take the money from, to take RA Ware's balance off of their books. And that's what they do. They pull the money out of the allowance for doubtful accounts from the debit side of that account, and they apply that to Ware's receivable account on their books. Right. So this is what the allowance method tells them to do. Take it from the allowance account to close out a bad receivable as they identify them through the year. So this is that pool of money that they've put aside to identify the bad accounts. When they identify bad accounts, that's the money they pull from to write it off. So what happens is nothing really in terms of the receivables, net receivables, the value of receivables is the same. This $500 allowance lowers the balance in the allowance account to $11,500, but this credit to receivables lowers the balance of receivables to $199,500. The difference is still $188,000 net realizable value. So nothing is going to change on the balance sheet, which is the idea. Okay, which is the idea. Well, what happens when a customer who you've written off their account, they show up and want to pay their bill? Well, again, this happened in July. Remember, they wrote this guy off back in March. So you got March, April, May, June, July. I mean, it's been 4 or 5 months. The guy pops in and says, "Hey, I want to pay my bill now." You don't stare at this person and say, "Well, we already wrote you off. Get out of here." No, you want to take the money. That's what it was supposed to be in the first place. So what happens if Ware ends up paying the amount that he owes? Well, the first thing you got to do is reinstate his account because you already wrote him off in essence. So that's easy. Put him back into the receivables. And the money you took out of the allowance account, put it back in for some other deadbeat. Okay. And then take the cash. Because in essence, this is what we want to happen to all receivables. Receivables should be turned into cash because that's what we're waiting to receive. We've already done the work. We're waiting to receive cash on that. That's what a receivable is. So clearly we want all receivables to turn into cash. But as you know, sometimes it doesn't happen. Now, would this really happen? Would someone like an RA Ware show up a few months later and pay a bill that they owe for so long? Yes, it would happen. Why is that? Well, because again, when you look at these receivables, it's a business to business transaction, right? You and I are not going to be able to go into a store, grab a bunch of stuff, and say, "Yeah, I'll pay you later." Right? We'll be in handcuffs. Um, so these are businesses doing business with other businesses who decide to sell them stuff on account, and they're waiting to receive the money later. So yes, if a business is having a hard time, look what's happening with the coronavirus. A lot of businesses are out of business, or they're struggling to pay their bills. So maybe there's an RA ware out there who hasn't paid their bill for several months. But now maybe as things get better and they have more money, they want to reestablish that trust in that relationship because they actually need to do business with that business. Then they might show up and say, "Look, I'm sorry, it's been a hard time, but I'm here to pay my bill. Yes, I know it's been 6 months. I know it's been a year, but I'm here to pay my bill. I want to reestablish our relationship, our business to business relationship." So yeah, this happens. I think it is reasonable to expect in some cases that this would happen. Okay. So all companies have to explain a little bit, right, about what type of how they value their receivables, and they will use the allowance method, and they'll explain certain things about it in their notes. So how do they estimate how much of their receivables will be bad debt? How do they estimate their allowance? Two ways to do it. The first way is the easiest. They simply take a percentage of their receivables. And in some cases, it's easy to say. I mean, if if you have a history of every year, 3% of your receivables are just not collected, why do you have to go through, an elaborate mathematical formula to do an estimation of your bad debt? You already had a history that mostly every year, 3% of your receivables are bad. So just use 3%. So that's the percentage of receivables method. It's quite simple. Okay. Um, that's one way to do it. Again, that's the easiest way to do it. The second way to do it is a little bit more uh, intense. It's a bit more accurate too. It's called an aging. Um, and other than what I'm doing in front of you right now, which is aging every class, an aging of a receivables works very much like this. They have a large sheet where they list all their customers and how much the customer owes them. The total receivables are listed here. Okay. Of course, of their receivables, they have to break it down into age. So many of these receivables are not due yet. So as you see, of the $39,600 of total receivables, right, 27,000 of these are not due yet. In other words, the due date has not happened. Because when you sell to someone on account, you usually wait 30 days to receive the money. So if you're still waiting to receive the money, it's in that 30-day period. It's not due yet. That's the case with our RC Bortz. Of the $300 that he owes, it's not due yet. The due date hasn't happened yet. For OL Diker, the $700 that he owes, I'm sorry, I'm just using he, I don't mean to genderize these things, but 500 of that 700 isn't due yet because the due date has not hit. So what they do is say, look, of all the accounts that are not due yet, we have estimated that about 2% of those are going to end up as bad debt. So this $540 listed here is 2% of the $27,000. They think this is of the amount that hasn't even been due yet. That's how much they've estimated they're going to write off. All these other columns, the due date has passed. The first column, the due date was either yesterday, because it's 1 day late, or up to 30 days late. And so as you see, $5,700 of this $39,000 is already late by anywhere from 1 day to 30 days. Now, just because someone's a day or two or week or two late doesn't mean they're not going to pay. There's a little bit of a chance that they might not, but some people just forget. People are busy, like, oh my God, I can't believe it was due. Yeah, here it is. So they think they're going to collect most of this. They think that 4% of this amount is not going to be collected. So of this $5,700 that's a little bit late, they have estimated that about 228 of that is going to be written off as bad debt. Well, as you see, as you start waiting for money, the longer you wait, generally, the less likely you're going to collect. Right? And so here you have this next column are the folks who have missed their due date between 1 and 2 months. They're 1 to 2 months late. Thankfully, it's only $3,000 of the 39,600 that's 1 to 2 months late. But look, now they're thinking at least 10% of this is not going to be collected. So they increased their estimate based on the age. So 300 of this they feel is going to be bad debt. 2 to 3 months late, again, not a large amount, only 2,000 of the 39,000, but boy, more and more of it they don't think they're going to see. Right? 20% of that they've designated as a write-off to bad debt. And over 3 months late, I mean, I'm not sure what you're going to do. Thankfully, it's a small amount, about 1,900. Look at that, 40% of that they've estimated they're never going to see. When you add all these together, they come out to $2,228. Okay. So that's the total of all of their estimates based on the age, right? The older the account is that you're waiting for, the more likely, right, the higher percentage of it you're not going to collect. That's basically how they've estimated. This is a very good way of doing it because they're using multiple rates based on the time, whereas the percentage of receivable basis just uses a single rate for the entire total. Okay. So once you've decided this is what you're going to be, this is what your estimate is, you've basically said that should be my balance in my allowance account. Okay. So what you've just done here is you have estimated your allowance account should be $2,228. That's what you want your balance to be. Okay. So if you're at the end of the period and you've estimated that that's what your balance should be, it shows on the allowance account you already have a balance of $528 in there on the credit side. It should be 2,228. So what can you write off that year? Well, you can only write off the difference. You can only write off the difference. So your bad debt expense for that year is going to be the difference of what you want the balance to be and what the balance already is that's in the account. So the difference here is 1,700. So your bad debt expense would be the debit for 1,700. You're going to adjust your allowance account with a credit of 1,700 because there's already $528 on the credit side there. If you credit it by another 1,700, you'll get to the 2,228. Thus, you can only write off what you can adjust your account to be. That's why it's the bad debt expense for this year. So your bad debt expense as an adjustment here, the adjustment here to the allowance account brings your balance to where you want it to be. You can't ignore the balance that's already the beginning balance that's in an account. But what you've calculated is basically your ending balance. So you simply adjust by what's already there. Okay. So here is the do it exercise for objective 2. You have Brule. They've been in business for 5 years. They have $30,000 of receivables. They have $180,000 worth of sales. That's nice. They have an allowance account. This is interesting. It has a $2,000 debit balance. Remember, allowance accounts normally have credit balances because they're a contra asset account. Okay. So the fact this account has a debit balance is important to note. Bad debts are estimated at 10% of receivables. Well, your receivables are $30,000. The estimate is 10% of that. So it's important to know what's in your allowance account. When you look at your allowance, I'm just going to make a little T account here for your allowance for doubtful accounts. Okay. Look what's happened. It has a $2,000 debit balance in it. That's what this says. What you've estimated is 10% of your receivables, which means when all is said and done, you want a $3,000 credit balance to be in the account because that's your estimate. 10% of your receivables is 3,000. So the question is, what are you going to write off that year? Well, you write off how you adjust your allowance account to get from the balance that's there already to the balance you want it to be. So the only way you get from a $2,000 debit balance to a $3,000 credit balance is you need to put $5,000 on the credit side, which means your write-off that year is going to be quite large. Your bad debt's going to be $5,000. And your credit to the allowance account is going to be $5,000. Okay. That's the toughest thing we have to do here. Everything else is going to be pretty straightforward. So I'll take a quick break and come back to our class to see if there's any questions on what we just did. No, but that's the toughest part. That's the part you're going to look at the most and try to figure out the most. Okay. Good news is the rest of the chapter is pretty straightforward. So you ready for it again? Okay, back we go. Okay, also as part of this objective, they introduce you to something called factoring. Factoring is when a company, when they need cash, of course, there's lots of ways for companies to get cash. They probably would have, in most cases, a line of credit from the bank they can pull from if they didn't have enough cash. But what you might not know is they can actually sell their receivables to a company called a factor. And a factor is basically a specialized finance company or a bank with a special department that collects these receivables. Okay. So this factor buys the receivables from that business for a discount. In other words, they give them the cash up front, but not all the cash that the receivables are worth. The difference is a commission. Those commissions usually are anywhere between 1% and 3% of the receivables that they have purchased, okay, from the business. So here's an illustration on a company that sold their receivables for cash to a factor. So here's another furniture company. I guess they're hooked on furniture here. Let's get comfortable then. $600,000 of receivables are sold from this furniture company to a company called Federal Factors. Federal Factors charges 2% as a service charge. Okay. So what is this furniture company going to do for a journal entry when they sell these receivables? Well, they have to account for the fact that they're not going to, they sold $600,000 worth of receivables, but because they've agreed to a 2% service charge, they have given up 12,000 of that to federal factors. Federal factors are going to give them the cash. That's the difference. So they're going to get a bunch of cash, but only 588,000. The 12,000 becomes an expense, and they're going to write off. Well, they're going to take away their 600,000 from receivables, and that's basically how they would raise cash, by selling receivables. Okay. Another thing that happens, a lot of people get confused, is because a lot of companies accept credit cards. And a lot of people confuse the use of a credit card with a receivable. And this explains that you don't need to. A credit card sale is a cash sale to a business. Okay. Because your credit card is issued by a bank. The bank is part of a network like Visa or MasterCard. And they forward the cash to the merchant on your behalf. So the merchant is getting cash. You're getting a bill. You're getting a bill, but the merchant is getting cash. However, in order for the merchant to participate in the network, they have agreed to pay a fee. So yes, they will be getting their cash from the sale, but they give up a certain part of that cash in the form of a fee. Okay. So if a company, again, if they accept credit cards, it's the same as a cash sale. It's just they're giving up a portion of that in a fee. There's a lot of advantages as to why retailers use credit cards. Okay. Because if they didn't use credit cards and they were setting up their own accounts receivable, they would have to do a full credit investigation of every customer to make sure you're good enough to keep your word. They'd have to maintain all those accounts, and if they needed to go to collection, they'd have to go to collection, and blah blah blah. It's all BS for them. They'd rather pay the fee to be part of the credit card network because it saves them all of that. Okay. And of course, having that lovely little MasterCard or Visa or other symbol means more sales to them. So here's an example illustration of a company that takes a credit card sale. Morgan Marie purchased $1,000 worth of music for her restaurant from Songeroff Music Company, and she charges it to her Visa. Okay. The service fee on the Visa charge is 3%. So Songeroff Music sold $1,000 worth of music, but they've agreed to pay the 3% fee as part of taking the Visa. So what does their entry look like? Well, the entry is they're going to show they sold $1,000 worth of music, but they're going to show they received only $970 of that in cash because they have incurred an expense, 3%, $30 expense, to use the Visa network to get their cash. Okay? So that's basically how all that works. No big deal. Objective 3 focuses on notes receivable. And again, a note receivable is simply, right, the word note means a loan. Well, how are these companies unless they're a bank, they're really not in the business of doing loans. So how do notes receivable usually become part of a company's books? Well, normally it starts as an accounts receivable in which the customer who you're waiting to receive the money from needs a longer time period to pay you. So you say, okay, look, I'm willing to wait 30 days, 60 days, 90 days, 120 days. Usually they're in 30-day intervals for a particular interest rate. So I'll postpone your due date of when to receive the money, but now you're going to owe me interest on top of that. So that's a note. That's a note receivable. So that's basically how most of them are born. although it is possible for companies to let other people borrow money, yes, but that's not normally how they're born. So so that's important to sort of understand. It is a promissory note. It is a loan. And most of the time it is to settle the accounts receivable as listed down here, like my little loops. A note is a signed promissory note. All right. So if you are the one who is the payee, um, you are basically giving the loan. So it's a note receivable to you. If you need the loan, you need to make the loan, you owe it. So it's a payable to you. So if you look at this, this is all the thing. You have a $1,000 loan, okay, that you made on May the 1st. The loan is for 2 months. So these notes are either in days, 30-day intervals, or months. That's it, 1, 2, 3, 4 months. So they're either going to state it in days or months. And that's important to know because we have to calculate interest. This loan is made to in order of the payee by the maker, right? And there's an agreed interest rate. Notice that this interest rate is annual, which means this interest rate is for all 12 months. That's important to note because most notes are not for 12 months. Most notes are for a much shorter period of time. So this is going to become interesting, get it, interesting, when we actually do calculations for interest. Okay. So the date that it's due is called a maturity date. Okay. And how notes receivable work is that you pay the full amount back with interest on the maturity date. So on the maturity date, you're collecting money that includes the original loan plus the interest on that loan on the same day. Okay. And notes are normally either listed in days or months. And that's important to know. When they are in days, they're in 30-day intervals, 30, 60, 90, 120, 150, etc. And of course, you know, if it's in months, it's in months, 1, 2, 3, 4, 5 months, what have you. That's important because of interest. Okay. And interest, of course, is a very important thing to know how to compute. So that's the big part of this objective, computing interest. And how it works is you take the actual loan, so whatever the note is, you multiply it by that annual rate. Now, again, that's important, the annual rate. And then because you're looking at a period of time that's usually less than a year, we're multiplying that by the time. And this is where it gets interesting, okay? Because the time is going to either be in days or months, okay? Yes, it can be in years, but most notes are short term, days or months. So this is important to note. Let's take a look at each note. They're in the rows. This is a $730 note at 12% for 120 days. If we use days, the time is the number of days over 360. It's always that. Okay. The number of days is always going to be 30, 60, 90, 120, etc. So here we have $730 times 12%. Again, this is the annual rate. So we have to break that down by the time. Times 120 days divided by 360 days. So the interest here, $29.20 is the interest on the note. On the maturity date, right, that 120 days is expired and it's due. They are going to collect all of the face value and all the interest at the same time. So they're going to be getting cash of $759.20. the face value and the interest added together. Well, that's on the maturity date. Here, our second note is a $1,000 loan at a 9% interest for 6 months. When it's in months, we use the number of months on the top over 12 because there's 12 months to the year. Okay, so for days, the number of days over 360. For months, the number of months over 12. Okay, and we need that for this part of the equation. $1,000 times 9% times times 6 divided by 12 will give us the $45 in interest. What are they going to collect on the maturity date? $1,045 in cash is going to be collected. Okay. So that's important to sort of know how to compute. So for the illustration here, you have this company, Brent Company wrote a $1,000 2-month promissory note to settle. If that's the case, it's usually to settle an account, usually to settle an accounts receivable. So they wrote it to Wilma. So Wilma is going to record this as a $1,000 debit to note receivable and a $1,000 credit to accounts receivable for Brent. So Brent's accounts receivable is paid by the note. That's what this is saying. Okay. So notes receivable, only two things can happen to a note. It's either paid on time, so it's called an honored note, or if the person or company misses the due date, again, if it's not paid in full, then it's called a dishonored note. The dishonored note. So just some terms to know. So here is an illustration from one company to another. Wolder lends Higley $10,000 on the 1st of June, accepting a 5-month 9% note. If Wolder presents the note to Higley on the November the 1st would be the maturity date. November the 1st is 5 months from June the 1st. Okay, July, August, September, October, November, 5. What would Wolder record for the collection of the note? Well, they would be collecting the note plus the interest at the same time. So they would be grabbing $10,375 in cash, of which $10,000 is the paid note. So $10,000 credit to note receivable shows that note is paid. Interest has to be recorded as revenue. So any interest you earn on a note is interest revenue. Okay. So in this case, the interest revenue is $375, and that's done by taking the 10,000 times the 9% times the 5 months divided by the 12-month period, and that's $375. Okay. So that's important. What happens, however, if a company like Wolder has a fiscal year that ended at the end of September? September 30th was the end of their fiscal year. Well, again, they made the note on June the 1st. They're not expecting payment on that note until November the 1st. But yet they have to close their books September the 30th. Okay. They're not going to receive the $375 until the note gets paid. But $300 of the $375 was earned in this fiscal year, not in that fiscal year. So they have to claim this $300 of interest as income or as revenue for this year, even though they're not going to collect it until the next fiscal year. So sometimes we do have to watch out for those fiscal year periods, because then closing entries are going to matter. So here we're going to indicate that we have an interest receivable at the end of, this should be September 30th. At the end of September, we're closing this out with an adjusting entry. So interest receivable would get a debit of 300. Interest revenue would get a credit of 300 because we have to show, right, revenue recognition where it was earned. That's the period it needs to be posted to. So that's why we have to show that in this fiscal year, even though we're not going to collect it until the next fiscal year. So in this case, when they did have that fiscal year closing on September 30th, and they had to make that entry, Wolder would have to make a slightly different entry on November the 1st. They'd still show they had received $10,375 in cash. 10,000 of that is the note receivable. But look how they broke up the interest, right? $300 of that interest was already recorded as revenue the previous year, and that's why we set up the receivable. So $300 of the interest receivable has been received. And the $75 difference here is the interest revenue for this fiscal year. And so do it exercise 3 is really just about notes. Okay, so take note of objective 3. So here we have Gambit Stores accepts from Leonard a 3,400 90-day 6% note in settlement of their overdue account. The maturity date is August the 8th. So what entry would Gambit make at the maturity date, right? So on August the 8th, they would be collecting $3,451. That's the $3,400 note and the $51 of interest, all paid in cash on the due date. 3,400 of that is the note receivable. $51 of that is interest revenue. And that's how we would record it. Okay, the last thing we're going to be doing is a little bit of analysis after we look at the balance sheet. This is Deere and Company. Okay, balance sheet for Deere and Company, it's a partial one. It only shows their receivables less their allowance. Less their allowance. And so here you have actually net receivables. So I don't know if you know about Deere and Company, but they make a lot of, well, they certainly make the sit-down lawnmowers and other types of things, but they're a lot of farm equipment, tractors, and things along this line. And as you see, for their total receivables, that's a lot of dough. Get it? That's Deere and Company. That's a lot of dough. Of course, they have to take away their allowance, so they have to shave off a few bucks. Sorry. And but that's still quite a decent amount of receivables, right? Oh dear, oh dear, oh dear. Okay, sorry. How would you manage your receivables? Pretty simple. Again, most of these are going to be from business to business sales. So who are you going to extend the credit to? What's your repayment period going to be? Again, for the vast majority of industries, it's 30 days. Some industries have a longer window, 45 days, 60 days in some industries. Of course, you have to monitor your collections because you want to make sure the cash is being received. And that means, you want to make sure your receivables are able to be liquidated into cash because you need that cash. And you might do everything you can to accelerate that cash when you can, maybe offer terms that encourage prompt payment. Okay. So that's what that talks about here. And the last thing are the actual financial analysis. So one of the most important things to note is this accounts receivable turnover. Okay. It's the number of time you collect your receivables during a period, and we're going to use a year for a period of time. Now, think about it. If you have a 30-day receivable window and your period is 1 year, your turnover of receivables should be 12 times a year, right? Because there's roughly 12 30-day periods in a year. So you should be collecting those 12 times a year. And that's what an accounts receivable turnover rate is. How many times per year are you collecting your receivables? Okay. Once you know what the turnover rate is per year, you can simply calculate the actual number of days, the collection period, by putting that turnover rate below 365. And that's basically what you're going to be seeing here. The accounts receivable turnover rate are the credit sales divided by the average receivables. To get average receivables, you take the beginning and ending, divide by 2. Okay. As you see for Nike in 2014, they had over 20, these are all in millions. So they had over $27 billion in credit sales. And when you divide that by the average receivables of about 3.2, almost 3.3 billion, they're collecting their receivables 8.5 times a year. Now, 8.5 times a year is not 12 times a year. It's actually much slower. So that's not necessarily all that great. But when you actually take, now that you know the turnover rate, if you put that under 365, it'll give you the collection period. So now that we know that for 2014, Nike had a receivable turnover rate of 8.5, when you put that under 365, you can see they're collecting their receivables roughly every 43 days. Okay, if we round it. That's a long time to wait because you want to get paid every 30 days. And here Nike's getting paid every 43 days, roughly speaking, in 2014. So that's not terrific. Well, compared with one of its competitors, Skechers here, here they have a turnover rate for their receivables of 9.6 times a year. Well, a higher rate than Nike means they're collecting them faster. They're collecting them faster. When you put that under 365, you'll see that Skechers is collecting their receivables every 38 days compared to Nike's roughly every 43 days. So a much faster collection of money. However, it's still 38 days. And for this industry, it's usually a 30-day receivable window. So 38 days is better than 43 days, but it is still a little sketchy to me. Okay. And the industry here, again, the industry, in this case, all of these athletic wear companies like Nike and Skechers, right? Their accounts receivable turnover is basically where it should be, 12 times a year, 12.2 times a year. That's exactly where it's supposed to be. When you take that and divide that under 365, you'll get roughly 30 days, right? So the industry basically is on time with its receivables. It's able to keep its receivables collected frequently. 12.2 times a year is perfect, roughly every 30 days. So that's terrific. That's really terrific. If I were, in charge of Nike, and I saw this 43 days compared to where all of our competitors are in the industry of collecting every 30 days, I would have a huge meeting and I would just be telling people, look at this. This is where we are. This is where we want to be. Just do it. Okay, sorry. Okay, so your do it exercise here, the analysis is just an example of what you would be doing here. So here in 2017, you had LeBron James Company. They had a lot of credit sales. They have beginning receivables. They have ending receivables. And they want you to compute the turnover rate and then the average days. So for the turnover, accounts turnover, you have net credit sales of 923, 795, divided by the average net receivables of around almost 37, right? 36 and a half. That gives you 24.9 times a year. This is much, much higher than 12. So these guys are collecting their receivables almost 25 times a year, whereas most companies are happy when they're collecting it at least 12 times a year. So when you put that under 365, it'll come out to basically collecting money every 2 weeks, which is outrageously quick. But what else would you expect from LeBron James? I don't know. So that is quite a lesson, but that is I'll take questions at this point.